Welcome everyone to this webinar. Gosh, it's been a while since we last got together. Hi everybody. Gosh, we've got a really big crowd. My name is Danielle Stein Fairhurst, coming to you from Sydney, which is still in lockdown. It is at 8 p.m. here in Sydney. We have got not one but two fabulous presenters for you this evening or this morning. Is it midday for you guys in Germany?
Us in Germany, it's midday, yes.
It's midday, okay. Yep. Yeah, so both we have Romina and Gary, Romina Badecke and Gary Knott coming to us from Germany. So yeah, it's my job every now and then, whenever we run these, to come up with these virtual meetups. So thank you so much for joining us. I have known Romina for a little while. It was Romina that I met first through the Women in Financial Modelling group. We get together every now and then, and we talk about all things financial modelling. And one of the things that we do is compete in the Financial Modelling World Cup. And Romina at the moment is one of the top women on the leaderboard for the Financial Modelling World Cup. So congratulations for that, Romina. It's so fantastic to see some women on the leaderboard now.
Thank you. The last stage didn't do me well, but hopefully next one again.
No, you've done really well, and I'm really looking forward to some of the battles that we've got coming up also. So I was very excited when Romina agreed for her and her colleague Gary to get together with us today and talk to us about cash flow forecasting. So I'll pass over to you, Gary. Gary's going to give us a presentation. Romina's going to take us through the model, and yeah, really looking forward to what you have in store for us today.
Thanks very much, Danielle. So yes, welcome to this webinar, 1 hour webinar on the subject of cash flow liquidity planning and forecasting in Excel. So just quick introduction. My name is Gary Knott. I'm a chartered accountant. I've got over 30 years experience, and much of that is modeling and data analysis. And for a few months now, I'm now an author. I have my book out. So you're welcome to buy that if you're interested in learning how to avoid Excel horror stories.
Yes, I've got my copy right here. It's very exciting.
Very good.
That arrived.
So have I.
You've got a copy too.
Okay, Romina.
Yes, hi everyone. Yes, thank you. Hi everyone, and thanks for the intro, Danielle. I've been working with Gary for almost a year now, and before that, many years in banking and finance, and always having lots of fun with Excel.
Okay, thanks for that. So we're going to start off with a couple of poll questions, 3 poll questions. So the first one is, how often should an organization perform or update cash flow and liquidity planning and forecasting? So you've signed up for this webinar because you have an interest in the subject. So I'm very interested to find out what you think is the correct rhythm. That's the first question. How often should you perform it? And then the second question is, how often does your organization actually perform cash flow, liquidity planning and forecasting? So obviously, how often you should will vary to some extent, depending on how much cash you have. If you're if you don't have much, then you maybe need to do it more often, but and also depending upon the seasonality and volatility of your industry, that may play a role. So how often do you think you should perform it? And then the second question is, how often does your organization actually perform? In a group, I find that's often defined by corporate processes or requirements. It's top down. Somebody at the top says how often you should do it, but yeah, is it enough? For example, to identify bottlenecks or actual improvements that you could make. So I'm very interested to see what the results are.
Yeah, we've got some interesting results. So we've got lots of people who have voted. So I might, so yeah, we've got 2 questions that you should be able to see on the screen now. So I'm going to end the poll and I'll share the results now, so we can see that, yeah, as we thought, a lot of people think that, yeah, you should perform cash flow, liquidity planning and forecasting, and then about 50% of people say you should do it monthly, and 41% of people say they actually do it monthly. Okay, that's interesting.
Yeah, so that's good. So that's, yeah, kind of matches up with my expectations. I would expect most people to say monthly, and that's good. And most people are, or yeah, 41% are doing it monthly. A few doing it less frequently, and a few people saying never doing it. But hopefully, because you've signed up for this webinar, you're interested in performing it. So we'll show you how to do that. So let's move on to the third and final poll question, which is how often, oh, sorry, not how often, how does your organization perform cash flow liquidity planning? What do you use? What tools do you use? Do you use Excel, or do you use a software? Or is it just from gut feeling, I think this is going to be a good month or a bad month, or some other option or a mixture of the above? So I think in the previous questions, I had an idea what to expect, but here I'm open for surprises. Interested to find out a battle between Excel and off-the-shelf or customized software. So let's see how that goes. Yes.
Did you want to share your screen so people can also see it in the recording, the question?
Yeah, I've lost the...
Yeah, that's okay.
Screen. So when you... okay, yeah, let me do that.
Okay, so we've got some results coming in. So I might just end the poll now and share the results so we can see. Yeah, as okay, no real surprise. I thought we might have had some surprises there. But yeah, it looks like 85% of people are using Excel for their cash flow, liquidity planning and forecasting. Only 6% are using software, 2% are using gut feeling, and 7% are using other or a mixture. So yeah, some interesting.
Okay, so hands down win for Excel. Okay,
yeah,
very good.
Yeah,
okay.
Excel.
Okay, so let's move on now. So we find that Excel is a very good tool to use. We've got very good experience of it. We've used it for a major project for a big client of ours, Majorel, worldwide, although it doesn't have to be a worldwide organization to make use of Excel. Obviously, Excel has a lot of advantages. It's well known, data available, it's flexible, and so on. And certainly our client is very happy with their tool. So what we're going to do now is we're going to explain you the 4 steps that we use to implement this tool for our client. Okay, so what are they? First of all, prepare. So no surprise, preparation, any big project is important. So organize the people and discuss what you need to get from the tool, what are the outputs, and then work back from the outputs to identify what you need as inputs. And what and very important point to decide upon early is the timescale for your planning tool. So we tend to use 13 weeks, and that's because 13 weeks, it's short enough to be accurate, but long enough to be useful. Okay, so once we've identified all those, then we can go ahead and start to develop our tool. And basically we need the inputs, the calculations, and the outputs. So the inputs are the inputs you identified in the first stage that you need to identify all the cash inflows and the outflows in your 13-week period. And where possible, to make it easier to update the tool and less time consuming, we try and use existing reports as far as possible. So typically those will be the AR reports and the AP reports. If you have any other reports like a flash report or a loan schedule, those can also be used in a cash planning tool to avoid having to reinvent the wheel and to make it more efficient for the users to update the tool every week or every month. Okay. Then that's where you'll spend most of your time. Then when you finish developing it, you need to go through a test phase. So you should obviously always test your model and parts of your model as you're developing it. But then once it's complete, you need to have a test phase. And what we did for our client, we had a 4-week test phase for each country where we implemented the tool. And that enabled us to really check that everything is working as desired and that users can effectively work with the tool so that they knew what data they needed, how to get it. They could improve processes to make sure they get the data necessary in a timely manner and update the tool. And also, it was important in the test phase to review the outputs to make sure that they are reliable, understandable, and useful. Okay, and if necessary, we then made some changes if necessary. And then finally, at the end of the test phase, we could go live with the tool, and that should be updated on a regular basis, i.e. every week or every month, and to monitor and improve your liquidity. So you can identify bottlenecks, for example, and decide what you want to do about them, or identify potential for working capital improvements. Okay, so that's the 4-stage process, and there are a lot more details in the handout, which you'll be getting after the webinar, which Danielle will send around to everybody. Oops, so yes, now it's time to...
Yeah, we'll send that out. By the way, if there's any questions, you can pop them in the Q&A down below for those of you who are joining us live, and we'll address those towards the end of the session.
Great, thanks very much, Danielle. Okay, so now we're going to head over to Excel, and I'll pass over to Romina.
Thanks, Gary. Sorry, I had to unmute myself. Yeah, perfect. And thanks for the overview. And now we're in Excel, where apparently all the cash flow planning magic happens everywhere, which is good. And this is, of course, a demo version of a model. The live version that we did for the client is a lot more detailed and has some more complexity, but I think this gives a very good overview as to how the inputs flow through the model and then are combined into meaningful and easy to process outputs. So every model we do, we basically do it in a structured way to just also align with financial modeling practices. So this one also has, like all our models, has a cover sheet that gives you an overview as to what inputs there are and how they go through the model, and they're all separated via divider sheets. And we usually build our models in a way that the inputs are to the right and they flow, or in the back of the model, and they flow through and then come to outputs. So we're going to have a quick first look at the outputs, because this is the target that we have in the tool where we want to end up. So this is the dashboard that kind of brings all of it together. It gives you a high-level view. Also including a data table for different scenarios that can be incorporated into the model. So this is basically just summarizing the inflows and the outflows and the resulting balances. As Gary said, it's over this period of 13 weeks. That is short enough to be accurate and long enough to be meaningful. And so this is where it's all ending up. Also, the results are summarized in a pivot table, so they can be analyzed more row by row, and you can go into some details here. And the most standardized output that all the data are flowing through, that has the highest level of detail but already brings everything together, is this cash flow plan. The cash flow plan also has some inputs. These could also be on a separate sheet, of course, but here for this model, we have them here. So that's the starting date of our cash flow model. And it has some data validation because it can only be a Sunday. That's we've set this to be the starting point. And then the week numbers and all that for the 13-week time frame is automatically calculated. The starting balance is also an input, as said, could also be on a separate sheet. And the inputs, the values that actually come through, and there we have some groupings with the cash inflows and the cash outflows, and we have several levels that we can look at depending on what specific line we're willing to look at, or we have some questions on, and just can find out where some of the movements that we've seen on the dashboards are coming from. And as we can see here, the cash flows on this cash flow plan are actually coming from an interface sheet. And this interface sheet is being fed from the inputs. So before we can have any outputs, we have to have a look at the inputs. And Gary is going to show you how the inputs are actually collected and brought into this interface.
Share my screen. Okay, so now you should be able to see the model on my computer. And as Romina explained, we have the outputs and they are fed from the inputs. So it's very important to have a number of inputs covering all of the cash flows you're expecting over the next 13 weeks. Okay, and we've split them into 4 areas, which we and each of these 4 areas we had a meeting with the client for each country where we implemented the tool and discussed one of these 4 areas. Then we adjusted the tool, tested it, and then the following week we discussed the changes we'd made for the area we just completed, make sure that was okay, and then we went on to discuss the new area. So what are these 4 areas?
Are you sharing your screen, Gary?
Yes. Okay. So yes. Okay. So yeah. Okay. Now. Okay. Thank you very much. So the 4 areas are cash inflows that you can get from a report. That's the AR report. And cash inflows, other cash inflows. That's typically things which are happening after on the AR. You can generally predict cash inflows depending on what your payment terms are of the next 4 to 8 weeks. And in our model, we want to have 13 weeks depicted. So we need to know what are the cash flows we expect to come in after that 4 to 8 week period. So that's why we need a second sheet. So what we call forecast revenues. We'll look at that in a second, to cover the other cash inflows from customers, which are expected after that period. So that's the second area. And then the third and fourth areas are related to outflows. So again, first of all, a report. So that's an AP report. That's showing us the unpaid vendor invoices. And that will again give us the cash outflows for the next 4 to 8 weeks. And then we have to cover anything else which is not covered. So where we haven't received the invoice yet, or where there's no invoice to be received. That's typically things like personnel costs, social security, and tax payments, and maybe loan payments. So those are the things. So let's have a look at those now. So AR. So this is the AR sheet, which we're going to focus on. We have on the left, we have the inputs of the report. So each week to update that, or each month to update that, you produce the report from your system. And we always customize this so that it exactly matches the way the report comes from your system. So if the columns are in a different order, then we just rearrange this so that it's really very easy to update each week. We don't want people having to paste in each column individually. So it's just a copy
Gary,
paste.
we have a request if maybe you could zoom in just a little bit.
Yes. Okay, good.
Thank you.
I can zoom in. Yes. So the absolute minimum amounts of information which you need for any of these input sheets is the amount and the date. So here we have the amount and the due date. Okay. And other information is also useful. For example, for your customers, it's also useful to have the customer name. It helps you better understand. But the absolute minimum are the date and the amount. Okay. So those are all here. And this, I will point out, we have formatted as an Excel table. So if you go into insert table, you can define a particular input area as a table, and that brings certain advantage with it. For example, if you create a pivot table, it will automatically include everything that's in your Excel table, including if you add any new items at the bottom. Okay, so this is the report on the left. Okay, and on the right-hand side, we've colored them blue because these are formulas or input cells on an input table, on an input sheet. So we want to make it clear, please don't overwrite these. These are formulas, and we have protected them so that they cannot be overwritten if you protect the whole model with a password. Okay, so what are we doing here? We've got 2 scenarios. So what we've defined the base scenario is the date when, if all customers paid on the due date, then that would be our base scenario. Okay, and that due date is generally comes from the system and is normally based upon the invoice date plus the payment terms for that customer. Okay, so that's when the particular customer should pay this invoice. But we all know that customers don't always pay on time, and therefore we want to have an adjusted scenario, which basically says for certain payments where we know the customer from experience that the customer pays later, or because, for example, there's a dispute on the invoice, or for some other reason, you want to plan a more realistic scenario. So we call that the adjusted scenario. And then you have the ability to input for any particular line item. For example, this one here is a large payment expected due date. Really, if the customer paid according to his payment terms, he should pay it on the 17th of August. But for some reason, there's a dispute, for example, on this particular invoice. So we expect the customer to pay about a month and a half later on the 4th of October. Okay, so that's our adjusted scenario. And in each case, we have the calendar week. So the calendar week is each week has a number. We're using the ISO week number. That's the function we're using in Excel to give us the number. And that's very useful for example, some ifs. We can use this calendar week number. Okay, we've also added the year to the calendar week number. So if we're going over from one year to another, there's no risk of counting a calendar week cash flow from the wrong year. Okay. So here we have the base scenario, the base payment date, based upon the payment terms for the customer, and the week, which is based upon that, the ISO calendar week. And then in some cases, we have an input of an adjusted date when we think the customer will really pay. And then we have this column, the adjusted scenario date. If there is a date here, then we take it. If not, then we assume it's the same as the base payment date. Okay, and then we calculate again the week number. And last, but by no means least, we have the date, the payment week that we want to use. And that is based upon the scenario. So the scenario up the top here is set here on the dashboard. We can select a base case or an adjusted case. That's just with data validation. And if I have a quick look at the data validation, we can see we've defined that as the list, and it comes from these two items here. Okay, so here the user can depict a certain scenario, and then that feeds through here. And in this formula here, it says, if the case is the base case, then I'm going to take the base scenario calendar week. And if it's not, then I'll take the adjusted case. And that's the week then we use for all further calculations to define the outputs. So that's our AR. We've got a couple of entries there, 3 entries in the adjusted payment scenario. One thing I'll also mention up here, we have the sum of the column and the subtotals of the column. I find this is very useful to have if you want to do any analysis. For example, if you select a particular customer here from the filters, the subtotal function will give you the sum of those items which are visible. If I can prove that down the bottom right, 622,391, that's the subtotal here. That can be very useful when you're analyzing data. Okay. So that's our AR. And as I say, this will cover us for the next 8 weeks, around 8 weeks up to calendar week. So we're in calendar week 31, the start of this tool up to 39, but we want to go further. So some things we haven't yet issued the invoice for, and therefore we need to plan those in the model as well. So we want to then have here on the forecast revenues, we have defined this input sheet. Now, as I said before, if there is a particular, for example, flash report or whatever the client or the organization wants to call it, if that's already available, then you should try and use that to try and minimize the time it takes to update the report each week, and also to ensure consistency between different forecasts. But in this case, we didn't have such a report. So what we've done here, we've defined the previous month and the current month and 2 further months, because all of these could give rise to cash flows in the next 13 weeks. And I must emphasize here, we must only include things which haven't been invoiced. Because if we included items which have been invoiced, then we would be double counting with items on the AR. So in this case, we're assuming that for July, we're at the start of August, we've issued all the invoices for July. There's just one here that's outstanding. There's a query on the client, so we put that in here. And what we've got here in each case is our list of the major customers and then all of the others. So in each case, we want to say how much are we going to expect, do we expect to raise an invoice for the work, or in this case, for the goods supplied in August. In this fictitious example, we're assuming it's a fashion company selling fashion clothing. And these are the clothing stores that they sell to. And this is a big customer, so they expect to sell for 874,000 in August. And then the question is, when does that money come in? So as I said before, the two things we need to know are that what is the amount? So that here is an input, and what is the expected payment date? And what we do there, we assume that it happens that the invoices are raised at the start of the month for the previous month, and that the customer pays according to his payment terms. And what we do there, we have a master data sheet where we list out the customers and we say, how long does it take to raise the invoice? What is their payment terms? And then in total, we have the total amount of time we expect it to take from the end of the month before we receive the cash in. Okay. So some clients which have a bit bigger customers, it may take longer to agree the invoice before we actually raise it. Then plus the payment days gives you our realistic expected time to payment. And those figures here are in a separate master data table, and they feed into here, into this column. So then we can work out that the date which they're expecting to pay is this date here, which is actually the end of the month. So 31st of August plus our 32 days gives us an expected payment date. And then we can work out our calendar week using the formula we had before, using the ISO week number. So here we've also got the amount and the calendar week when we want to pay it, when we expect to receive the payment. Okay. So that's the second category of inputs. And then we've got the outputs. So similar to AP, we start with similar to AR, we have the AP, which is our list of outstanding invoices which we haven't paid to suppliers. Okay. So here, similar to the AR, we have a report from the system on the left-hand side. And again, we make sure that this is structured so the columns are in exactly the same order as the report comes from the system. So it's very easy to update each week or each month. Whoever's updating the tool produces the new report on the Monday morning, for example, and copies and pastes the data in. Okay, so that's the left-hand side. And on the right-hand side, again, we have some formulas, which are basically the same formulas as we had on the AR, with one exception. We have an extra column here, and that is for a category. So what we want to do is we don't want to throw all of our cash outflows into one bucket, to one line on the cash flow plan. We want to know what are we spending money on? Yeah. So there we have a category identified. And basically this is coming from an AP master data sheet, because normally each supplier supplies one particular kind of items or services or goods. So we can know that Bling Limited in this case is supplying clothing and transport. That's one of our main suppliers for clothing, which we sell on. Digit is IT and telephone, and so on. And this is a category which we have using a drop down, and this drop down we have using a list. So in data validation, we have selected a list, and the list is coming from our cash flow plan here at the front. So that's useful. And that can then feed into our AP list here. So we do a lookup using index match of the supplier name to find what is the category for this particular supplier. And then these categories we can also use on our output cash flow plan to split out our cash flows into categories, so that we know why are we spending money, what are we spending it on. Okay, but the rest is the same as the AR sheet. We have the base scenario date, which is basically the date which comes from here. The reason why we have an extra column is we make sure that this date is not in the past. So our tool starts on the 2nd of August. So you can't pay, if he hasn't paid now, he can't pay in the past. So we have to make sure that it's a minimum. It has to be at least the start date of the tool. That's why we have this extra column. Then we work out the calendar week and the year. And for our adjusted scenario, which is our more realistic scenario, we're going to offer the ability to enter here in this input column. In our models, the gray cells are the inputs, the ability to input a realistic payment date. And if there's an input there, we take that for our adjusted scenario. If there's nothing, then we assume, okay, then the base scenario is the date to take. And then we have our adjusted scenario calendar week. And similarly to the AR, we take the payment calendar week used is based upon what scenario is selected. So if you've selected the base case, we'll take the base case. So let's show it here. Here, the base case at the moment, the base case is selected. So we will take this calendar week 34 and not the 36. If I go to the dashboard and change that to the adjusted case and go back to my AP, then we can see now, because I've got adjusted case, it's now taking the adjusted calendar week here. Okay, so that's something which is very flexible in the model. Okay, so that's AP. And then we have other items which similar to AR, it only covers, AR report only covers cash inflows for the next 4 to 8 weeks. We want to know what are the extra inflows. That's why we use forecast revenues. Similarly, on the cash outflow side, our AP list will show us the payments going out in the next 4 to 8 weeks. And we need to know what other payments are going to happen after that. Plus, we need to know any payments which are going to happen, which never appear on the AP. And those are things like the salaries, the payroll tax, and tax. So VAT, corporate tax, and maybe some CapEx there. That should be, if you are buying some equipment, presumably you will get an invoice, but if you haven't ordered it yet, you don't have the invoice, then you should plan that here as well. So basically what we've done is we've got an input block for each of the categories that we have on our cash flow plan, and the ability to input the 2 minimum pieces of information, the amount and the date. And in our models, the cash outflows are always entered as a negative amount. If I try and input a positive amount, it will give me a warning. That we've done with data validation. So that's quite useful. So I've defined here the data validation. It must be a decimal and it must be less than 0, i.e. negative. And if someone tries to input a positive amount, they will get a warning. I could put a stop and say that's not allowed, but I put a warning because it can be, for example, with VAT or tax that you normally pay out, but it could be for some reason you get a payment in. So it just gives you a warning. And if you want to really put a positive number in, you can say, yes, I want to accept that. And then it's accepted even though it's a positive number. Okay. So that's how to use data validation to try and help ensure that your inputs are correct. And another item we have here is the loan schedule. So this is something which is already available at the client. So we've just used that here, copied and pasted it in, and we've got the amounts which are due here, capital payments and interest, and we have the dates when they're due to be made. So again, we have the minimum amounts of information we need, the date and the amounts, and we can also calculate the calendar week. Something here to bear in mind is when you're looking at AP or any other report from the system, particularly with payments out, are the numbers shown as positive or negative? So in this case, they are shown as positive, but we want them in our cash flow to be negative. So we have to take account of that when we are doing our formulas. Okay, so that's the inputs. So we have the inputs for cash inflows and outflows for the next 13 weeks. And as Romina briefly mentioned before, they feed through an interface into the outputs. So I'll now hand back to Romina to show us how the interface works. So Romina, are you able to please take over and show us the interface?
Yes,
which I think is,
all right.
Great.
Yeah, I think I should be sharing by now, and should be could be heard again. Great. I was trying to answer some questions in the chat as well, but we'll also have some Q&A when we're done. So I think there were some great questions already. Yes, thanks, Gary. And back to the interface sheet. The question could be: do we actually need this interface sheet, or could we just link the cash flow plan with all different formulas to all of these individual sheets? The answer is yes. We could also leave the interface sheet out and link directly to these sheets. However, we think this interface sheet has a few great advantages. For once, you could, because like in our example, in our live tool, for example, we have many countries that use the same tool. and they all have different AR reports, AP reports, and therefore their input sheets all look a little different. And if you then go to consolidate anything, it's much easier if you can go through an interface sheet and collect the data in all the same format, and you just need to have different links into the different formatted input sheets, but then you'll get the same output everywhere. So you can customize your input sheets, but you still have a common output sheet through this interface. Then also in the cash flow plan, you can use the same formula, the same sum ifs. You don't have to, for each row, come up with a new formula that takes into account all the various formats of these input sheets. So you can just use all your cash flow plan formulas, make them go to this interface sheet, and use the same criteria because it's all the same here. And then as a third and fourth point, also this interface sheet is very easy to consolidate, for example, via Power Query. We are big fans of Power Query to consolidate data and to bring them all together. And this is already a perfect format for Power Query to work with it. Or also, and that's what this pivot that I showed briefly before is based on. You have all these categories here. You can easily do a pivot on this interface sheet, and you cannot as easily do a pivot on the cash flow plan or on any of the individual input sheets. So here you can just have this nice overview, and then filter with using these slicers that I find are a very helpful tool in Excel, where you can just drill down using very different categories that are all defined here in the interface. So you have all these inputs, and they flow through. So that's the reason for using the interface sheet, and it's a really helpful tool if you want to continue working with the data, or if you have any interest in consolidating it. But even if you have just one tool to analyze it in a pivot, this is the perfect format. So now that we have looked at behind the screen, where are the data coming from in the inputs, how are they processed into the interface via just links into these tables that Gary showed you, then we can now have a closer look as to how they are actually worked with in this cash flow plan that we looked at earlier. So as I mentioned, when we looked at the interface sheet, we can here now just very easily look at these formulas, and we can use basically the same sum ifs formula. And I'm sure you've all heard of this sum if formula. Is one of the most powerful functions I find in Excel, where you bring together all the values based on various parameters, various dimensions. So for example, this sum ifs looks into the interface sheet, and it looks for all the rows that have accounts payable and rent and building, and that are in this week where 31, and they bring back this amount. So if you see here the interface sheet, that's where it's all coming from in the cash flow plan through the different dimensions. The only place where you have one less criterion is here in the AR. That's because there in the AR you don't have a separate category. If you remember the interface sheet, in AR we have the customer name and forecast revenue, and in AP we have these various categories, and that's why we have one dimension more here in the sum ifs. But basically it's all the very same formula, just with a different number of criteria, and therefore it's this is also could be very customizable to your needs, depending on what level of detail you want to show in your cash flow plan and what categories you want to show. You could customize that to your needs and have more or less detail in the interface. But for this demo, that's about the level of detail we think is reasonable, and it also is similar to what we're using in the live tool. And one last little perk that I think is pretty cool, or maybe just, yeah, I think we have the time for it. What we have also done here in this demo is we've used some of the new dynamic array functions that Excel is also providing, because here, if you remember it, we also have the customer names in our interface sheet. And in this, we don't need it on the cash flow overview, because we have all the AR and it's all there. But if you wanted to add an analysis based on the customer and see what are your top customers, you can use these really cool new functions with the dynamic arrays, and with a unique function, find all your customer names first that you use in the AR, and then use the sort function to actually have your biggest customers first and have it all add up. And yeah, that's how you build your cash flow plan based on this interface sheet. And then, as always, it's important to add a few checks into your model to make sure the totals in this column add up with the totals across your columns. And that's a very important thing to have in every model. Just your checks, and then your master check to make sure that it's all accounted for, and that you're not missing any data, and that maybe your range is too short or whatever. With tables, that's less of a risk, but always make sure you check your data for completeness. And I think with that, we can actually open it up for Q&A. And
very good.
See what
Thank you.
Great. We've got lots of questions in the chat. And,
very good. Let's get started.
Yeah. Okay.
Yes, please.
All right. Might go with the last one first. VAT is an input rather than related to the sales and purchases forecast. So that is just a single cell input. Is that right? So you would just change that if necessary.
Yeah, that's correct. We've made the experience, if you try to calculate it based upon the other inputs, it's never so accurate as you might want, and it's easier just to input a figure based upon historical data. That's what we've found. But you could, of course, try to calculate it, but it makes it more complicated. You have to know for each inflow and outflow how much VAT is on it, and when is the invoice point rather than the cash flow point, because that's relevant for the VAT payment. So basically, you could do it, but it makes it more complicated. In my experience, it's easier to use as an input.
There's more of a comment or question from Henry about this view of cash forecasting. How would this relate to the standard 3 financial statements approach to cash flow forecasting? So if you were to take a more macro view to take into account all of the balance sheet change impacts, I assume this is just a part of, it's just for the cash flow. If you needed to add the balance sheet, you would be able to add that in over the top. Is that right?
Yes. So yeah, I think with this is as someone asked, it's there's two basic methods of producing a cash flow. One is the three-way model, where you plan your P&L and balance sheet and you calculate your cash flow as a derived cash flow, or you do it like we're doing here as a direct cash flow, where you directly plan all of the individual cash flows and add them up, and that I find is more accurate. But as you say, you could then build from the 3 financial statement types of the P&L, balance sheet, and cash flow. If you have 2 of them, you can calculate what the third one is. If you had the P&L, for example, you could then calculate your balance sheet based upon the two of them.
And I think that kind of leads into the other question we had about will this tool be available for sale and training? It's not a tool that's going to be made available publicly, from what I understand, from what you've told me, that it is, we just wanted to demonstrate a tool that you can build. It's just in Excel. It's just an example of the kind of thing that you can build in Excel.
Exactly.
Yeah. Did you want to add to that?
And if you want any more details, you can either look at the recording, which will be made available afterwards, and also all participants will get a handout with more details. It's a PDF handout, which will explain the steps in more detail for you to follow.
Great. Just another question from Gabriella, forecast versus actual. How do you check the consistency of forecast versus actual, and how does the model give recommendations to the user on what should be changed based on those analysis results?
Yeah, so that's something we didn't have in this demo model, but in the real model, we have a deviation analysis where you look at the balance, your opening balance you have at the start of this week, which is an input, and you compare it to the balance which you planned to have when you did your planning last week or last month. And then if there are any big differences, you need to have a look at that and understand where they're coming from. And the idea is to try and improve the accuracy of your forecasting in future.
And to add,
we found that normally when there's a big difference, it's just because a major customer paid later than expected, or in some cases earlier. So
and
Romina,
somebody else, I wanted to add on to that. Somebody else asked in the chat if there would be a possibility to actually incorporate actuals into this tool, and that's a very good question because we get that asked a lot by the client as well. And I have built one analysis model for one of the large entities where they actually put in last week's forecast and then compare line by line with their SAP data based on a mapping with which SAP line goes into which cash flow line, and they find that very helpful to actually analyze their deviations, and they have a lot of movements. But to incorporate that as that whole thing into the tool would just take it to a level of complexity where I think it's no longer very user friendly, because you always have to keep that in mind. Also, the varying quality of some users. Somebody might be very new to Excel and might struggle, and also with various levels of business acumen and stuff. So that's why there's not a detailed analysis of the actuals. You can do it, but it just makes it so much heavier.
I like this one. How long did the tool take to build?
Oh, yes.
That's what I want to know. I know how long it would take me to build. Quite a long time.
Yeah.
Amazing.
Yeah. We've built it over several months, continually developing it and adding new functionality.
Iterative process.
And you also have to think not just the developing time, but also the planning time, getting the data, making sure the data is in the right format. So maybe a week longer if you have more complexity to get a basic cash flow model up and running.
So we have quite a few questions still, but I might let you guys, I'm not sure that we're going to get to all of them. I might let you guys go through and pick the questions that you'd like to answer in the few minutes that we have left.
Okay, yes, so we've got a question about the week number formula. I see there, I can
that's a good one.
I can give that one. We're using not the function ISO week number as opposed to the week number, because the ISO week numbers, those weeks are all seven days long. And if you use the week number, when you go from one year to the next, the last week of the year and the first week of the new year, they are normally not 7 days long. And we want in our tool to have all of the weeks to be 7 days long, so that you can compare the cash flows. Otherwise, you're comparing cash flows of 7 days with cash flows of 2 days, for example. So that's why we've used that. I can post that in the chat. So let's go on to ask another question, and let's have a look here. So So what else have we got? So I'm just typing here the week number. It's a bit complicated.
Oh, wow.
It looks a bit complicated, but it's basically the core of it is the ISO week number, and the complicated part of it is to work out what the year is, because I wanted to have the year on the end. Yeah, so
Okay, thanks
it's
for
only a
that.
problem when you're in the last week of the year or the first week of the new year. Then it's a bit more complicated, and there's the formula.
Wow, wow, okay.
Okay, but
Cool.
once you've got it set up, you can use it everywhere. Yeah, so it's build once, use many times. Yeah. Well, that's what in my new book, I've got this principle called COUNT, which stands for calculate once, use numerous times, or in this case, it's you build the formula once, you can use the formula multiple times. Okay. Good.
I don't know if you've got time to address the question from Gabriella that's come through.
What is she asking?
Q&A. How do you deal with last moment adjustments that the client wants to do via the fact that many calculations go through Power Query, which is not that elastic and easy to understand? So do you have input cells for that? And do you have different levels of Power Query connections so that all the data doesn't have to recalculate from scratch when it's connected to the database? It's even worse. So if you're pulling data in through Power Query or however it's coming in.
Yes. So Romina is our Power Query expert. Do you want to answer that one, Romina?
Yeah, sure. Well, it's the nature of things, as you're correctly saying, Gabriella, for the consolidation. For our live tool in Majorel, we were doing the consolidation macro base actually at the moment, so on a regional level, and they, by the time they submit, they have a final view of things. For planning purposes, we've started using Power Query, and there I'm actually facing exactly the same things you're mentioning, and I've also, as you suggested, tried building the Power Query model in a way that some things just remain constant, and that only on top changes are included in the refresh. But yeah, that's something we're also still working on, and here for the consolidation, for the planning, that we're doing it for the client. So it's when you've built the Power Query model, it's easier it's easy to understand. If you want to hand it over to the client, it gets that much more complex. So I don't have the perfect answer to your question, because I'm feeling the same challenges, to be honest.
But I think what we tend to use is for such situations, we connect Power Query with the folder, and then if you get an updated version, you store the new version in the folder, refresh, and then you've got the new data.
Yeah.
But I think part of the answer is really to have a good process where you have deadlines set, and the people know they have to submit the final version by Tuesday at midday, and then any changes which come after that won't be taken into account. If it happens to be a major change, and in that week the reporting is going to senior management, then maybe you do a quick refresh. But otherwise, you say, okay, please learn for the future and put it in next week's forecast.
That's a good thing about having a weekly. It's you get every week, you get a chance to correct it. Correct your assumptions.
I don't know if we probably got time for one more question. If you want to pick one of those questions out, and then we will have to leave it there.
Yes. In the demo version, it's only one adjusted date, but you could add a functionality. I mean, you could, in theory, have multiple adjusted dates, but we find that just the base scenario and the adjusted scenario, that works well. It's not too complicated, and really, the adjusted scenario should be the realistic one. You don't want 2 or 3 realistic scenarios. Yeah. So if necessary, plan conservatively. So assume that the customer will pay later than expected, to see the impact on your cash, and then your cash flow outputs and your dashboard. You can see if there are any weeks when for example, you have what I call a bottleneck. So that's where, for example, the planned cash balance is going down below what your minimum is that you want to have, or the minimum that you have as available as an overdraft facility. And that's the key advantage of this tool. You can see in advance that that's coming up, and you can decide to take action. And that's where our client found this tool very useful, particularly during the COVID-19 pandemic. They could then run some different scenarios to see what is the impact going to be, and take action appropriately to, for example, secure extra financing.
Someone's asked about the tools and add-ins that you use to help build this. I think I know the answer to that question, which is it's just using standard Excel. Is that right? Did you use any add-ins?
No, it's just standard Excel. Yes.
Yeah. So, that's the fabulous thing. The thing that I absolutely love about Excel is that you can build a tool like this just using your bare hands and your keyboard and the tool that we have available to us, which we already have, and everybody knows how to do it, and that's Excel. And
that's the big advantage.
Yeah, I love that.
That's why so many of us are big Excel fans. It's it's so powerful, and they're adding new functionality all the time.
Yeah. All right. So
Gary has a little tool. We have your toolkit, Gary. Gary has built a little add-in himself.
Okay, do a quick plug. It's just for quick things, which are, for example, it's not to build, it's more to use. For example, to go to on each sheet, make each sheet the same size, and put the cursor in the top left corner.
Okay. Yes.
Or create like a table of contents, those kind of things. It's quite neat, but it's not a. It's on eloquence, but it's not a huge one of the big add-ins.
All right. Thank you so much, guys. That was really informative. I will send out a copy of the recording. We're also going to share a copy of the chat, because there's a lot of stuff going on in the chat.
Yes.
And some of the what we've talked about may not make sense without the chat. So I'm going to make sure that we share that as well. So thank you so much, guys. We've got another session coming up in about 3 weeks' time. So I look forward to seeing you then. All right.
Let me just finally say thank you very much, Danielle, for organising that. That was very good.
You're very welcome. We've had a great class.
And thanks for hosting.
Yes. All right.
Thank you so much.
Bye-bye.